Welcome to this session entitled CARES Act Program, sponsored by Consolidated Billing Services. Your speakers today are Bill Ulrich, President and CEO of Consolidated Billing Services, joined by Mark Reagan of Hooper, Lundy, and Bookman.
Hi, everybody. It's Mark Reagan. I'm the General Counsel of CAHF and the Managing Partner of Hooper, Lundy, and Bookman. I'm joined today by my friend Bill Ulrich, who is the CEO of Consolidated Billing, and we're going to be talking about the CARES Act and Provider Relief Fund. As everybody probably knows, Congress stepped in with some significant federal financial help, which continues to this day with respect to healthcare providers and the additional cost and lost revenue that they're experiencing as a result of COVID-19. Next slide. This program will focus on any number of significant outstanding questions, and I wish that Bill and I would be able to definitively answer them all. There are many open issues, and there is a continuous stream of new guidance, new frequently asked questions, and they seem to add to the significant questions that we'll be talking about. Some of those questions include, what is the existing hierarchy between the statute, the terms and conditions, FAQs, and various reporting instructions, and which control? How will we determine what are qualifying expenditures for CARES? How do state Medicaid monies be treated when calculating lost revenue, or how to prove COVID-related expense? Do costs need to be incremental, meaning additional in nature in order to be counted? Does the provider have to account for how the value-based purchasing tranche, which is just in the midst of being distributed, or spent? We don't think so, but we have yet to receive a definitive answer. What specific costs can be applied to the infection control tranche? What is lost revenue and how is it calculated? What happens when there's a parent company, and does it have the ability to move monies received across subsidiaries? And are providers limited to increased year-over-year cost? Many of these will be what we will be focusing on for the remainder of our program. Next slide. So, as you all know, in order to receive a CARES Act distribution, there must be an attestation to the terms and conditions. The terms and conditions were shaped originally for the general and targeted distributions around the notion of the healthcare provider actually providing healthcare services after January 31st of this year. The first phase of the general distribution also required Medicare billings in 2019. That was because that particular tranche was tied in some way based upon that particular revenue. Also, the provider has to be in good standing, not currently terminated, not currently excluded, or billing privileges revoked. Next slide. And the key elements that, and this recites the congressional language, that the recipient certifies that payment will only be used to prevent, prepare for, and respond to COVID-19. And the healthcare expenditures and lost revenues must be attributable to COVID. And last but not least, and a terribly difficult question currently to answer, is how the provider will be able to determine what other sources are obligated to reimburse expenditures that are associated with COVID, if any at all. Next slide, please. As we can see, the nursing home infection control distribution is entirely separate from what the funds can be expended upon. The last two slides focused on what all of the other CARES Act requirements are for either spending or lost revenue. Most of the items that involve the infection control distribution are related to infection control spending. Just recognize that these are a subset of the overall CARES distributions. So the amount of the infection control targeted distribution received by long-term care providers needs to be demonstrated to have been used for costs associated with administering testing, the reporting of test results, hiring staff associated with infection control, with respect to infection control programs such as infection control mentorship, And then providing additional services to residents, such as technology, to permit them to be able to connect with their families and the like. Obviously, that is indirectly related to infection control, but nevertheless, a part of what can be spent for this particular tranche. Next slide. There are very unique attestations that are also present at the end of the actual portion of the portal that speaks to the overall terms and conditions. One of the more important ones is to understand that none of the CARES Act money can be used to pay executive compensation. That's the term of art. It doesn't actually refer to somebody exclusively being an executive, but anybody's compensation in excess of $197,300 must not be taken from CARES Act funds. And last but not least, an IT network requirement that the healthcare providers network must block the viewing, downloading, and exchanging of pornography. That's a check the box. Make sure you have that in place. There are other unique terms and conditions, but those are the ones that we believe are most applicable to our profession. Next slide.
Okay, this is Bill Ulrich, and I wanted to spend a few minutes talking about the accounting and tracking of COVID-19 related expenses and lost revenue. Next slide, please. So one of the main criteria we have to look at is that a dollar spent can only be used or counted to prove one and only funding source. So we know we've got multiple funding sources, whether it's from provider relief funds, payroll protection program loans, other potential funding sources. And once you spend a dollar to prove one of those funding sources, you can also spend that same dollar to prove a secondary funding source. In addition to that, none of the funding sources we're talking about actually are reimbursing the provider for COVID-19 related costs. Rather, the provider is demonstrating that they used those costs, and there's a fundamental difference between reimbursing for a cost and proving we spent the money in accordance with the various guidelines. Finally, there's a logical order that funding should be substantiated, although I think some people disagree on what that order may be. Next slide, please. So a cost can only be used in one bucket. Imagine the bucket itself is the funding source and the water is the expense. If you put your expense in one bucket, it can't flow through into another one of these buckets of funding. Next slide, please. So the hierarchy of funding may look something like this. And for those of you that listened in on a presentation that Mark and I did back in early July, you'll notice some potential changes in this slide. It is pretty clear that PPP program loans, once forgiven, are going to be used to fund various payroll, rent, et cetera. We also have monies related to benefits for people that had to take sick leave related to COVID-19. We have other funding sources we need to look at, but the final two buckets on this slide are really where the debate is, I believe. Traditionally, Medicaid likes to sit in the last payment. In other words, they're the payers of last resort. But in this particular situation, we have CARES Act guidance and funding that shows that the CARES Act actually sits in the last position. Next slide, please. So traditionally, Medicaid add-ons would be included as routine revenue. And in this case, we need to figure out if Medicaid rate add-ons are part of routine revenue or whether they should be used to offset COVID-related expenses. In going through the latest frequently asked questions, HHS seems to be using them both ways. It's our concern that these funds can either be used in the comparison of routine revenues, patient-related revenues, if you will, or be used to offset expenses related to COVID, but they should not be used for both because that would essentially be counting them in two buckets. Next slide, please. So nursing homes receive up to 4 grants, which provide funding to cover either lost revenue or incremental expenses. Initially, these grants should be probably accounted for as deferred revenue until all the terms and conditions are met and the provider can actually meet the terms and conditions and be able to, with good guidance, be able to submit and know that we're going to get to keep this money. Once these funds are booked into revenue, we have received guidance on the frequently asked questions back on August 26th that revenue should be recorded on the Medicare cost report on Schedule G3 as other revenues. Next slide, please. Other funding sources are generally local and may include the remuneration of cash or supplies, may include anything you might have received from a not-for-profit entity, a local a charity, a city or county government. And remember, if these funds are being used to reimburse costs related to COVID, then those costs can't also be used to substantiate a provider relief fund payment. It's also important to remember that the costs of underlying services or supplies are allowable costs, and that these grants are merely there to compensate the provider, but it's not appropriate to reduce allowable costs unless you have specific guidance to do so from your state Medicaid or Medi-Cal agency. We have received guidance from the on the federal side that the CARES Act dollars are not there and should not be offset against costs on the Medicare cost report. Next slide, please. So accurate tracking of these costs is very important. We've got two fundamental things we need to think about here. One is, what is the incremental cost, and what is that incremental cost related to COVID? I think the second issue is going to be harder to substantiate. In other words, it's pretty, from a mathematical standpoint, it's pretty simple to go in and see what costs are incremental, whether we're talking about it on a whole dollar basis or whether we're talking about it on a cost per patient day basis. The harder hurdle, if you will, is going to be to determine how to prove those costs are related to COVID. Some providers have chosen to isolate COVID-related expenses into their own accounts. While that is important, I think the first two criteria are more important. And we do have to remember, when it comes to cost reporting, a dietary cost is still a dietary cost. So if we're putting all COVID-related costs into one account, we then will need to break that back out to do a cost report. Next slide, please. So there's a bunch of frequently asked questions, much to Mark's and my chagrin, that came out on August 28, 2020, as we were finalizing this presentation. And this was a wealth of information that came out on the heels of updated CARES Act accounting and reporting guidance that came out the week before. So digesting the changes in the October 22nd update to the CARES Act accounting and reporting guidance, and then the numerous frequently asked questions that came out on October 28th related to CARES Act is a substantial hurdle. And the one thing I think we can agree on is that we are going to see additional clarifications come out in the next few months that we're going to have to take into account before we are reporting. But what we know now is what's in those frequently asked questions. And one of those questions had to do with the order of FEMA-related funding. And they specifically said, in answering that question, that we need to look at assuring that we are offsetting revenues from patient sources. And problematic within this answer, they talked about looking at applying amounts received through other sources, billing, commercial insurance, Medicare, Medicaid, reimbursement from private relief fund, claims reimbursement to healthcare providers and facilities for testing, treatment, and vaccine administration. So they seem to be looking at additional revenues from all payer sources in offsetting COVID-related expenses. Next slide, please. So the next question that we were looking at is, what are operating revenues from patient care? And HHS considers operating revenues from patient care to be net patient service revenues. In other words, we're looking at gross revenues less contractual adjustments, less charity care adjustments, and less bad debt or other discount or adjustments necessary to arrive at net patient revenue. There is some conflict within the frequently asked questions as to what is considered patient-related revenue. Next slide, please. Another question that they had is, what is operating expense from patient care? And this generally includes most of the expenses that are required to care for residents within your facility. The things that they specifically excluded from patient care expense is contributions, gains, and losses for investments are excluded from the patient care side. So next slide, please. One of the more problematic questions that came out on October 28, 2020 is how does cost reimbursement relate to my provider relief fund payment? Now, the answer to this question basically says that if your Medicaid or potentially Medicare agency reimbursed you more than the cost of care, that you have no ability to offset additional costs against the provider relief fund payments. This is a very problematic approach, especially for those states such as Medi-Cal that has a cost-based reimbursement system. Next slide, please. How does other assistance factor into my reporting expense? Other assistance received is reported as operating revenue and used in the calculation of year-over-year change in patient care-related revenue. The problem we have in this answer is we don't have a perfectly clear picture of what is other assistance received versus what is patient care revenue. Next slide, please. Do providers report total purchase price of capital equipment or other depreciated value? The answer to this question is mind-boggling in many respects, because we have an answer that looks at either accrual or cash basis accounting. And if you're using one of those, and I'm not entirely clear what you would be using other than one of those two, you may report relevant depreciation amount based on the equipment's useful life. They also provide in the final part of this answer that if you purchase equipment that has a life less than 12 months, then you can essentially expense that and include that on your submission that's due in February for 2020 or the first 6 months of 2021. What they do not make clear here is anything to do with a typical Medicare capitalization policy, depreciation lives, or anything along those lines when it comes to capital equipment and how it should be treated. So I really feel like we need a great deal more clarification on this answer. Next slide, please. So the next three slides all relate to the same question. And when reporting my organization's healthcare expenses attributable to coronavirus, how do I calculate the expenses attributable, not reimbursed from other sources? So we essentially have a multi-step process. The first thing that needs to happen is you need to determine if there are incremental expenses. And the second thing that needs to happen is we need to determine if those expenses are related to coronavirus. The next thing that needs to happen is determining what revenues have been received to determine if some of those incremental coronavirus-related expenses are offset. Next slide, please. So one of the examples they provide, and I like this example a lot, because while this example is looking at an office visit, it's calculating the office cost on a per visit basis. Now, my analysis immediately goes to the nursing home where we calculate costs on a per patient day basis. And I really feel that the two are very alike, and one can be inferred from the other. So in this particular example, we have an office visit prior to COVID that cost $80 a visit, and the post-pandemic average expense with COVID is $85 a visit. Next slide, please. They then go into a long analysis using 5 different payers, looking at, do we have expenses that we can claim to offset our provider relief fund payments? And in their examples, they look at a Medicaid reimbursement rate of $70. And since we have a $5 increase and the $70 is less than the total cost, we do not have to offset any revenues. Medicare reimbursement, they look at $80, and we're still below the provider relief, or excuse me, the COVID-related expense. The example I particularly like is example 3, where they're looking at commercial insurance reimbursement of $85. But since, even though that $85 covers the full cost of the office visit with COVID expense, since that $85 does not specifically identify a $5 add-on related to COVID, they allow us to include the $5 for COVID-related expenses, because the commercial insurer did not specifically reimburse that incremental expense. Example 4, however, where they show a $5 incremental revenue from the commercial insurer, they therefore do not allow us to offset the COVID-related additional office expense. Next slide, please. Another example we have is looking at expenses on a whole dollar basis, and the answer here is essentially the same, and there is some confusion at the bottom of this slide, because while we're looking at PPP supplies in 2019 versus 2020 with a $3,000 overall increase, which they say on the one hand are over and above normal operations attributable to coronavirus. In the very next sentence, they talk about how that $3,000 only has $2,500 attributable to coronavirus. I have a feeling they just have a misprint here. But what's important is that they are now saying that you have $2,500 that's attributable to coronavirus. You'll have to look at what money was reimbursed by other sources, and in their example, there's $1,000, leaving a balance of $1,500. So we need to determine if this slide is prescriptive. In other words, we need to look at whole dollars, or whether we can look at a cost per visit concept, such as in the earlier example. Next slide, please. So one of the other questions they asked is, what documentation is required for reporting? Essentially, they say that you don't have to have documentation, but that they will be providing, that you don't have to submit the documentation as to how you came up with the various costs, but they are going to provide a supporting worksheet for providers who received $500,000 or more in provider relief fund payments. I think I speak for most healthcare consultants when I say I really wish we could see the supporting worksheet sooner rather than later. They also then talk about retention requirements, which they put at a 3-year time frame. Next slide, please.
And next slide after that. Thanks, Bill. So Bill's been talking about, and you've heard him use the terms cash and accrual basis. This is language from a particular FAQ that made it clear that either approach is supportable. And so when we look at cost recognition, we will look at both whether or not the organization that you're affiliated with uses a cash or an accrual basis, and both suffice. Bill also talked about the notion that we continue to get updated FAQs and other additional information. You will note in the second bullet point that deals with the notion of lost revenues. You'll see where it says net of the healthcare related expenses attributable to coronavirus calculated under step 1. Yesterday, there was a new FAQ that essentially deletes everything after that particular comma. So recognize that even as we speak, some of these FAQs are essentially changing. And this is a summary slide that essentially says healthcare related expenses attributable to COVID are going to be qualified as long as they're not reimbursed or obligated by some other source. And then lost revenue is calculated without regard to trying to net out after healthcare related expenses. Next slide. So there are really 2 reporting periods, and there are 2 measurement periods. The first measurement period is through the end of the calendar year with a reporting date of February 15th. HHS takes the point of view that if you have not documented or capable of documenting additional expenditures attributable to COVID or lost revenues by the end of the calendar year, then you'll have 6 additional months. And each one of these reporting periods will be compared to the same quarters or the same period in 2019. Next slide. One of the outstanding and somewhat infuriating questions is how to deal with parent-subsidiary relationships, or what even those are, or what it is that HHS takes the point of view that they are. This particular FAQ essentially says that in a parent-subsidiary relationship, with respect to the general distributions, money that was received by the subsidiary can be essentially sent upward to the parent organization and then allocated and transferred to other subsidiary companies. This may be hugely important with respect to the notion that some of the additional expenditures may be greater at some subsidiary organizations than others. The big significant question, however, is what is a parent and what is a subsidiary for CARES Act reporting purposes? There's no definition associated with either of those terms. Is it possible to extend those concepts to a home office environment or other administrative services company? That's a question that will require additional clarification. Next slide. Again, they answer a question about what is a taxpayer or a tax identification number, but actually don't go about trying to describe what a parent or subsidiary is for CARES Act purposes. Next slide. And the next one. And one more. Okay, one of the things that we found that was a pleasant surprise in the October 22nd update of the reporting guidelines, which followed the one in September, was that in addition to what is determined to be healthcare related expenditures, also general and administrative expenditures that are attributable to COVID-19 and are not covered by other sources are also justifiable as additional expenditures. And the questions really will be, looking at general and administrative expenditures, what are those that are associated with COVID-19? Mortgage, rent. There may be opportunities to claim that in some element of lower census may actually allow some allocation of some additional mortgage or rent by virtue of a downgrade of census by virtue of COVID-19. That will require also further advice or further guidance. Some insurance has gone up by virtue of COVID-19, or there have been other ramifications associated with insurance. Certainly, although oddly placed here, personnel, actual labor costs, which are inevitably going to be significant drivers of expenditures. For some reason, HHS felt that it was incumbent to place them in G&A rather than healthcare-related expenses. Next slide. And then fringe benefits, any lease payments that can be attributable, utilities and operations, or other general and administrative expense, again, attributable to COVID-19 and not reimbursed or obligated to be reimbursed from any other source. Next slide. So, and this is quite frankly the core of what HHS has decided are healthcare related expenses. We would have expected that caregiver labor would be in here, but it's placed in general administration. Here you see the core of what they determine to be supplies and equipment, which are the things that you would expect in terms of PPE, hand sanitizer, supplies for patient screening, disinfecting, all of those additional supplies, and then any equipment that was purchased during the reporting period, upgrades to HVAC systems, subject to Bill's discussion associated with potential depreciation. Next slide. Again, more healthcare related expenses, IT costs that were driven by COVID, facility costs with respect to particularly associated with the physical modification or temporary structure placement with respect to patient treatment practices. I believe that also visitation would support this as well. And then a catch-all other healthcare related expenses. Next slide. Okay, here we start to see some weird line drawing, and you can see that this is from the most recent large set of FAQs. Can provider relief payments be used to support COVID-19 vaccine distribution? And this may not be particularly germane to our profession, but you can see that, yes, if it's involved in purchasing additional refrigerator, personnel costs to provide vaccinations, acquiring doses of a vaccine, transportation costs. Next slide. But contrast this to the next FAQ that deals with, what about paying for the vaccination? No, you cannot claim the actual provider relief funds used for that because HHS says that those will be reimbursed from other sources, Medicare, Medicaid, CHIP, and the like. So distribution is okay, administration is not. Next slide. Basic FAQ, use of funds for salaries and employee compensation, full or part-time suffices, contract labor, anything that involves additional labor costs does not have to be an employee, can be an independent contractor, as long as they are attributable to COVID-19 and not reimbursed by other sources. Next slide. So again, fringe benefits. Yes, fringe benefits that are attributable to either the related salary increases, bonuses, hazard pay, hero pay, and any other fringe benefits that were attributable to COVID that were paid are also claimable. Next slide. Here's an important one that we've been talking to a lot of clients about. Can providers allocate parent overhead costs? Again, calling into question, what's the parent? Because we have lots of different configurations. What's important here is that if you are part of an organization that provides, for example, consulting services, administrative services, management services, that includes providing support of individual facilities, what's clear is that an overhead allocation should be absolutely qualifying under the circumstances. Next slide. So again, when calculating general and administrative expenses attributable, HHS wants us to then estimate the portion of those expenses that were not covered through operational revenues and other direct assistance, which calls into question the point that Bill made about, does Medi-Cal, and let's call it the base rate, cover general and administrative expenses of this type? The answer from my point of view would be no, because it does not cover additional costs, and in fact doesn't even provide coverage for the costs of care at a 100% level. But there are issues associated with the 10% supplemental Medi-Cal reimbursement. And as Bill also indicated, what's important to understand is that whether or not the additional 10% Medi-Cal support gets calculated in the expenditure bucket or in the lost revenue bucket, it only should be accounted for once. Next slide. Observations and implications. Obviously, the good news, even though it's subject to a lot of additional question, is HHS has expanded the universe of expenditures to move from not only healthcare related, but to general and administrative expenditures. What's unclear is, given the list of general and administrative expenditures, whether or not we can take advantage of some of the lower census and attribute some of those other general and administrative expenses to COVID-19, even though they did not produce actual incremental additional cost. And then, does HHS have the actual legal justification to calculate costs year over year? Nothing in the congressional language or the terms and conditions limit the expenditure base between 2019 and 20. So there's a significant open question there. And then at the end of the day, as Bill said, it would be really helpful to have the reporting template sooner to be able to resolve, at least from a computation point of view, how this report is actually going to look. Next slide.
All right, thank you, Mark. I think one of the most controversial things that has happened since June is the back and forth we've experienced on the definition of how to calculate lost revenue. Just a real brief couple month history here. In the June frequently asked questions, HHS released guidance which gave us a lot of latitude and a lot of ability to define what lost revenue was. In other words, it wasn't prescriptive in calculating it against 2019 revenue. It was not prescriptive, as in the September release that came out where they in fact converted lost revenue to a lost net income concept. There was a lot of pushback on that, and the September guidance was replaced by the October 22 guidance. Essentially what we're looking at today is that reporting entities will provide information to calculate lost revenues, and it's represented as a negative change in year-over-year actual revenue from patient care-related sources. I think we need additional definition on what is meant by patient care-related sources. And the last part of this, where it says revenues and expenses include lost patient revenues and patient care costs over expense impacts, the expense piece has been removed. Next slide, please. So when we look at net revenues, we are looking at revenues gross less the contractual allowances, less our bad debts, less other particular expense-related write-offs. But they're asking us to report this on a quarterly basis for both 2019 and 2020, despite guidance that they're just going to be doing a year-over-year comparison. Next slide, please. So they've come up with several categories of revenue from patient care, and some of them are pretty obvious. Medicare Part A and Part B includes net revenues from that program. Medicare Part C or Medicare Advantage, Medicaid, actual revenues from the Medicaid program, commercial insurance, self-pay, and then the last one is a little bit more difficult to ascertain what they're meaning here. The actual gross revenues from other sources received for patient care services and not included in the list above for the calendar year. So I'm a little challenged to determine what they mean here by other sources received for patient care that's not included in the list above. Next slide, please. Some other assistance received, which one could assume by reading the October 22 guidance that these are not part of patient care revenue, albeit in other frequently asked questions they seem to consider these part of patient care revenue. But these other assistance received would include things like your PPP loans, other CARES Act grants, FEMA money to reimburse the provider, CARES Act testing related to coronavirus testing and related activities. Next slide. Additional other assistance is going to look at local, state, and tribal government assistance you may have received. Business insurance for those few providers that were able to get some type of lost business compensation from their insurance related to COVID. And then, of course, other assistance, which could be any other federal receipts that are not included in the above criteria. Next slide. So one of the questions that they put out on October 28th asked if I've expended all my funds through the GA and healthcare related expenses, am I still required to support or submit lost revenue information? And the answer is yes. If you have more than $10,000 that you received, you have to report information for lost revenue even if you're not claiming lost revenue to substantiate your provider relief fund payments. Next slide. Can I use 2020 budgeted revenues as a basis for reporting lost revenues? And the answer to this is no. Now, if we go back to the June frequently asked questions, the answer to this was yes. And so this has been a significant change. Additionally, in their detailed answer, they talk again about the comparison between 2019 and 2020 as the only way to calculate lost revenues. This is essentially telling providers that if you had low revenues in 2019 because of, you could have had a bad survey, you could have been on stop placement, there's a number of reasons 2019 might not have been a good year. If you have increased revenues in 2020, you will not have lost revenues. The other side of this is that if you choose to use the additional 6 months in 2021, you would be comparing lost revenues in the first 6 months of 2021 to the same period in 2019, in other words, January through June of 2019. Next slide, please. What is the maximum allocated of my organization's provider relief fund that can be allocated to lost revenue? Essentially, you can allocate provider relief fund payments to lost revenue up to the difference between your 2019 to 2020 reduction in patient care revenue, up to, of course, the amount of provider relief fund payments that you received in the first place. If you aren't able to attribute all of your provider relief fund payments again in 2020, you've got that additional 6 months in 2021 that we can report, and that report would be due July 31st of 2021. Next slide, please. When reporting use of funds, how will my organization lost revenues attributable to coronavirus be calculated? Again, this is a different way of answering the same question. We're comparing 2019 to 2020, and it gives, again, the reporting guidelines here for when we would submit those various reports. Next slide, please. When considering what is considered when calculating total revenue net charges, this is an interesting frequently asked question because it essentially mimics the information that's in the October 22 accounting and reporting guidance. However, it conflicts with other frequently asked questions when they're indicating that we would need to offset other provider relief fund payments, PPP, when calculating lost revenue. So there's additional information that we need to get in clarity, we need to get on what exactly is considered in the lost revenue calculation when you have those additional payments. Next slide, please. So what does all this mean? The October 22nd release certainly is better than the September release, but is not as good as what we saw back on June 19th in the frequently asked questions, where we had a lot more latitude in trying to determine our lost revenue. The determination of lost revenue is now more consistent with the CARES Act legislation and the intent of Congress. The standard is much more prescriptive rather than the previous concept of any reasonable method of estimation. And obviously, the idea of comparing it to a budget seems to be out the window at this point. The requirement of utilizing other revenue sources before determination of forgiveness seem to be unfair and conflict with generally accepted accounting principles. In other words, we may not know by February 15th if we are able to retain our payroll protection monies, or if we have to pay that money back, or if it becomes a loan. We do not know at this point how that's going to play out because we're just beginning the process of requesting relief from that money. And certainly, we have a lot of uncertainty relating to the template and how the portal is going to work. I think most providers certainly believe that it would be nice to see the template and actually what we need to fill out sooner rather than later. Next slide, please. Other significant takeaways. We know that qualifying expenditures and lost revenues may be incurred through June 30th, 2021, with that final report being due July 31st of 2021. The revised guidance would indicate that if a provider had a bad year in 2019, it deserves to have a bad year in 2020. And I put this in here because when you look at the lost revenue calculation, if you had low revenues in 2019, and there's a number of reasons for this, you are going to have low revenues or even lower revenues in 2020 in order to show lost revenue. Initial reporting deadline remains. We haven't seen a change to that. And then, as Mark spoke about earlier, we have a lot of confusion related to parent companies moving resources. Exactly what is a parent? What is a subsidiary? Is this synonymous with a Medicare home office? Are they referring to an ownership criteria when they're talking about parent and subsidiaries? So we need more clarification on that. And then next slide. So here we've got our email addresses and our contact information should you have questions on this presentation. So with that, thank you.
Thank you very much. Appreciate your time and attention.